Hello and welcome to the chapter 2 video for managerial accounting. In this chapter, now that we've been provided with an overview of managerial accounting, distinguishing it from financial accounting, we learned the uses of managerial accounting and we saw how it supports managers within organizations. Now we're going to continue to lay that foundation for managerial accounting by looking at some key terms. We're going to examine how costs behave. And then in the second half, not in this video, but in another video, we'll look at some cost estimation techniques. And of course, those key terms and the behavior will provide the foundation we need before we can actually do any real calculation. So in the first part of this chapter, no real calculations just yet. But when we get to the second half, that's where the fun really begins. All right, let's jump into it. So let's start by defining some basic cost terms and let's look at classifying costs in accordance with behavior. So the first term we're going to look at is a variable cost. Now, before I jump into these key terms, let me provide you with a bit of a foundation because a cost is a sacrifice of resources. Now, if you're familiar with accounting, you may hear the term cost and your mind immediately goes to expenses. And that's great because expenses are a type of cost, but not all costs are expenses. There are some other costs that we could possibly have that are absolutely not expenses. Now, we know expenses are amounts incurred to help us generate revenue because you got to spend money to make money, right? What if we were to purchase a building or a piece of land? We would not record that as an expense in financial accounting. Buying a building or the building itself is an asset. So that would be known as an outlay. Now, the cost of the building, yes, of course, there's a cost associated with it, but not all costs are expenses. So when we think of cost, I don't want you to just lock yourself into an expense and it's immediately going to impact my profits. I want you to think about a sacrifice of resources. So whether we are paying down a loan, or if we are buying an asset, all of those would be included in the category of a cost. So now, when it comes to costs, we can classify costs in different ways. We can classify costs in terms of how they behave, which means how they respond to some type of activity or some type of cost driver. We can classify costs in terms of some type of cost object, meaning what the cost is related to. If I eliminated the cost object, would the cost still be there? We can also classify costs in accordance with function, meaning is the cost associated with making my product or is the cost associated with running my business? So we're going to start with classifying costs by behavior. In other words, how it responds to a change in activity. So my first definition or first term here is a variable cost. Now, all variable costs in total change with a level of activity. So if the activity increases or the thing that causes the cost to increase, if that thing increases, then the total cost will actually increase. Variable costs per unit remain the same regardless of the level of activity. So let me give you an example. Let's say that I want to purchase the wood in order to make this pencil. And the wood for this pencil, and my numbers are not going to make any sense at all, but just go with me. The wood for this pencil is $5 for each pound of wood. Or why I would measure in pound and not square footage, I don't know. But we can make it per pound, per square footage. But the cost is $5 per pound. Now, if I order 20 pounds of wood, then that's going to cost me a whole lot more than just 1 pound of wood. So notice that as the pounds change, the pounds is my activity, the total variable costs will change as well. So variable costs in total change with the level of activity. Now, let's see this in graph form because this is important from the standpoint of making decisions. Typically, our variable costs will change proportionately with sales. So if sales increase by 10%, then our variable costs will usually increase by 10% as well. So when you look at this on the graph, I want you to keep in mind that when you see the x-axis here, as we're running horizontally, we're talking about sales volume or number of units or pounds of material. But that is the activity. So X is my activity. So I'm taking you back to probably fifth grade, where you learned basic algebra, maybe sixth grade, I don't know. But when you learn basic algebra, basic graphing, and you started with your x-axis and your y-axis. From an accounting standpoint, the x-axis is going to be some type of activity. The y-axis, that my vertical axis here, that's going to be my dollars. Typically, I'm talking about variable cost or costs in general. So I have my X. If my sales volume is zero, then my variable cost in total will be zero as well. So I start at 0, 0. And notice that I'm moving up in this nice, beautiful straight line that is proportionate. Now, I do want you to keep in mind that variable cost per unit typically it's going to remain the same. So whether I order 20 pounds of material or 1 pound of material, I'm still paying $5 per pound, but the cost in total is what will change. Now, don't worry about this down here just yet. We'll talk about this in a second. And I'll make all that make sense. But for right now, just know the basic definition of variable cost and know what your y-axis is and what your x-axis means. Now let's move on to the next one, which is, I went too fast, a fixed cost. Now, a fixed cost in total does not change with the level of activity. So regardless of how many pounds of material you order in this example, this cost would remain the same. Now, let me give you a better example outside of ordering materials. Let's say that you are renting an apartment. And when you sign that lease, you sign the lease to pay $1,200 a month for the next year. You get to the first month of the lease and you're there on day one and you stay there for all 30 days. Guess what? For 31 days. You're going to pay $1,200 a month. Now we get to month two. Let's say that you still live there, but you went on vacation for half the month. So you were only there for 15 days out of the month. How much do you think you're going to have to pay in rent? The full 1,200. They don't care how many days you were there. That cost is fixed. It remains the same regardless of how many days you're there, regardless of a change in activity. So let's see this on a graph. So notice when we were dealing with variable costs, we started at 0, 0. We still have the same x-axis, still the same y-axis. It's just now we're looking at total fixed costs instead of total variable costs. But we're not starting at 0, 0 because even if we have no days of staying in that apartment, as long as we've signed that contract, we still have to pay the same amount of rent. So we get that nice flat line that pretty much remains the same. Now, this remains the same typically within the short run. If we're talking about a longer period of time, this cost may jump up, especially if I'm looking at a lease agreement and the lease is for 1 year. Well, when I get to year two, the cost may jump up. So we're talking about things from a short run perspective. Now, take a look at this. Because remember good old-fashioned slope. Remember from way back when in Algebra 1, when you learned y equals mx plus b. And you had your x variable and your y variable, and then you had to find the slope. M was represented by the slope. Well, that comes into play as we talk about our cost estimation technique. So I want you to keep in the back of your mind, dust off those cobwebs from y equals mx plus b because we're going to use that again. But for this line, of course, there is no slope. Now, let's look at the next category. The next category would be a mixed cost. In other words, there is a fixed component and a variable component. You'll see this a lot with utility bills, water, electricity, phone bills, things of that nature. Now, a really long time ago, we used to pay for text messages by the text message. It was 10 cents a message. So you had in that bill the flat rate for the period, usually whatever Verizon, whatever contract you agreed to with Verizon or T-Mobile or whoever it was. You had that amount, and then you would pay by the text message. So, of course, the more text messages you send, the larger your bill would be for that particular period. Well, the total bill is an example of a mixed cost. It has a variable component, that cost per text message, and then it has the fixed component, the cost of the contract. Now, when we look at this on the graph, notice that my graph changes. So when it's purely a variable cost, we start at 0, 0. But when there is a fixed cost, that line is not going to start at 0. The line is going to start at the level or the dollar value of the fixed cost. And then the line continues to increase with usage, or the line goes up as the level of activity goes up. So we can see the variable portion as well as the fixed portion. Now, if you are looking at, say, an income statement for a company, on that income statement, there are going to be fixed costs and variable costs. Total costs or total expenses on that income statement will represent a mixed cost. For a mixed cost, we can use the equation of a line that I mentioned a few minutes ago, y equals mx plus b. We can use this equation to help us estimate our costs for a given period of time. But it's important that we know the variables. Now, we're used to probably y equals mx plus b. So I'm going to say this from the perspective of y equals mx plus b. And then I'm going to reconcile that with what you see on the slide here. So with y equals mx plus b, y represents your total cost. That's your total mixed cost. M is the slope. Yes, in algebraic terms, it's a slope, but in accounting terms, that is the variable cost per unit. The X is our activity. So when I take M and multiply it by X, that is equal to my variable cost. Now, B is simply my constant. And my constant is really just my fixed cost. So what we're saying when we say y equals mx plus b, we're saying that total mixed cost is equal to variable cost plus fixed cost. Now, your book, for I don't know why, but your textbook likes to change these variables, and that's okay. I don't want you to be confused by that. But whenever you see something connected to the x in that equation, I want you to immediately remember that is my variable cost, because for my variable cost, I have to multiply that cost per unit times the activity level. So here, it's still, y is still my total cost, that mixed cost. And I have a fixed component and a variable component. So the A in this equation represents the fixed component, and the B times the X represents the variable component. B is the slope or the variable cost per unit, and X is still the activity. All right, so we have variable costs, we have fixed costs, and we've seen those combine to make mixed costs. Remember, we're talking about classifying costs in accordance with behavior, how they respond to a change in activity level. So there's one more that we need to see, and that is a stepwise cost or a step cost. With a step cost, it's really interesting because it really does look like a fixed cost over a short period of time. But then the cost jumps up, but it's not in direct proportion like we see with the variable cost. And after it jumps up, it stays flat for a little bit of time. And then the activity goes continues to increase and the cost jumps up again. So it sort of stays fixed over a short period of time and then it jumps up. Let me show it to you on a graph while I talk to you about the example that I like to give you because it'll make more sense when you see it on the graph. There we go. So it looks like a step. That's why we call it a stepwise or a step cost. Now, let's say that I'm running a call center. And right now in that call center, I just have one employee working because I have low volumes of calls on a given day. And one employee can handle anywhere from 1 to 500 calls per day. Now, is that realistic? I have no idea, but just go with me for a second. 1 to 500 calls a day is what an individual can handle. Now, as soon as I have 501 calls, I have to hire another employee. And when I hire another employee, then my cost is going to increase because the cost over here represents how much I pay the one employee. If I hire another employee, that cost is going to jump up. But the only way I can handle a volume of more than 500 calls is by hiring someone else. So my hope is that my volume will be from 501 calls to 1,000 calls. So at that point, all I need is two employees. But if I get above 1,000 calls in my call center, I'm going to have to hire someone else. And notice that cost is going to have to jump up again because I can't pay the person by the call. I'm usually not going to pay the person by the call. I'm actually going to hire someone to come in to manage this next level. And then once I exhaust and I get above 1,500 calls, on that 1,501st call, then I need to hire another employee. So with the stepwise cost, it does look like a fixed cost, but as that activity level starts to increase, then my cost jumps way up. Another example is if you were renting and the rent was a certain amount per square footage and you wanted to add on an additional 500 square feet, well, then that cost would jump up. And then if you want to add on another 500 square feet, the cost would jump up. Oops, let me go back. Now, because companies have variable costs and fixed costs and stepwise costs, it gives us another way of looking at companies and we analyze them through this term called cost structure. And it sounds really fancy, but it's not. It's just the makeup of fixed costs versus variable costs within a given organization. In other words, some companies have more fixed costs than variable costs. Some companies are the opposite. They have more variable costs than fixed costs. Why is this important? Well, remember that variable costs will change in proportion with sales. So if you increase sales by 10%, then your variable costs will increase by 10%, and that's great. But most companies don't have all variable costs. They have some fixed costs. So what does that mean? Well, just because you increase sales by 10%, it does not mean that your profits will increase by 10%. Because if you increase your sales, your variable costs will go up by that same percentage, but your fixed costs will remain the same. You're still going to have those fixed costs there. Now, even worse, if sales happen to fall. So if sales decrease, variable costs will decrease in proportion, but the fixed costs will still be there. So you'll be in big trouble because you'll still need to cover your fixed costs. That's what I'm talking about when I say cost structure. In these situations, you have companies that are more sensitive to changes in sales levels than others because of their cost structures. Well, in recent years, companies have shifted to more fixed costs than variable costs. With automation and technology, there's just more money going into items that are fixed versus variable. So because of that, that's a lot of times why you see companies constantly increasing their prices, because if there is a dip in demand and sales fall, yes, variable costs go down, but profits will end up going down as well because they still need to cover their fixed costs. They're not bringing in enough revenue to cover those fixed costs. So you see a lot of price increases. Now, when you start increasing prices, You start going into that death spiral where things get worse and worse and worse, and you ultimately end up losing customers. So, there are other ways to deal with this. And one of the ways to deal with this shifting in cost structure and having a decrease in sales is through outsourcing. With outsourcing, you don't have to worry about covering as much in fixed costs. You only have to simply cover the cost of outsourcing itself. So that's one of the strategies that's used to deal with things, especially in recent years. Oh, sorry. Let me go back now because there are some important assumptions that we make when it comes to cost behavior. First of all, we are assuming that there is an actual relationship between the number of units we sell and our actual cost. If there's no relationship, then any estimate that we try to come up with is not going to make sense at all. The other assumption we make is that we're working within a shorter time period because if the time period is too long, then we're going to have to incorporate some other changes and our estimates won't be good at all. So, because we're dealing with this shorter time period, we don't have to worry about shifts in our cost drivers or what happens when we're close to capacity. So, we have to keep those assumptions in mind as we analyze cost by behavior. Now, let's look at estimating our cost equation. We already have the foundation for this. We know that y equals mx plus b. We know what each one of those components mean. So let's jump right into it. All right, so on this graph, we have all of our costs here. We have our mixed costs, and shaded in, we have our variable cost as well as our fixed cost. For the equation of a line for our mixed cost here, that's the y equals mx plus b. And we've already talked about this. I've already shown you what each one of these mean. Keep in mind when you see something multiplied by x, that's your variable cost. Could be mx, could be bx. And then your constant, it could be b, it could be a, depending on what you decide to use. But that is just your fixed cost. So total cost equals fixed cost plus variable cost. Now, everything that I'm telling you or I've told you about variable costs and fixed costs, there's one more assumption that I didn't cover. Uh, all of this information is only true within the relevant range. And the relevant range is that level of activity where the company normally operates. It is where a fixed cost is truly fixed. It's where a variable cost is truly variable. In other words, my cost line is linear. Now, this is just an estimate. If I go outside of my relevant range, then my estimate is not going to be reliable because outside of the relevant range, fixed costs aren't really fixed. They don't really stay the same, especially when I start to get close to excess capacity or if I'm operating below my normal capacity. And this is because of the idea of a marginal cost. Now, the marginal cost is the additional or incremental cost of making one more unit. So when we see this on this slide here, the marginal cost will increase when I am outside of my normal activity range. So when I am close to capacity, my marginal cost or the cost of producing one more unit may require me to purchase a new piece of equipment, or it may require me to expand my facilities. So because of that, my costs will jump way up. So I'm not going to be able to make a good estimate, and my fixed costs won't truly be fixed. So, economists, when we look at an actual cost, a cost is really curvilinear, meaning it's all over the place, like a roller coaster. And economists can handle that. They can handle the curvilinear pattern of a cost. But as accountants, we cannot because we can't estimate what's going to happen when those marginal costs get too high because I am putting a stress on my capacity. Or on the flip side of that, when I have excess capacity, I have all these costs that need to be covered, but I'm not going to have enough products to spread those costs across, or I'm not going to have enough sales volume to absorb all of those costs. So that's going to give me high marginal costs if I'm operating below my normal range of activity. So as accountants, we only look at the flat part of the curve. We ignore all of these little fluctuations here and we look at the flat part of the curve and we call that our relevant range. This is where a fixed cost is truly fixed and a variable cost is truly variable. There we go. And this slide here probably does a better job than me of explaining, because you have pictures explaining how the accountants can only deal with the flat part of the curve, but the economists see it as a function and they can deal with uh, all the curves and roller coasters. Now, let's take a look at this. So, we're going to distinguish between some costs here, between total cost, variable cost, and average cost. So this company has monthly fixed costs that include rent and depreciation on tools and furniture. It also has variable costs that include direct labor and any materials used in repair, such as new screens. So notice that for a variable cost in total, yes, it changes with the level of activity, but per unit, it remains the same. So on this table here, we have the number of customer repairs. And here's what I want you to focus on. See how the number of repairs, customer repairs, increase. The variable cost per repair still remains the same. Now, the total cost here is a mixed cost. It has a variable component and a fixed component. The fixed component in total remains the same. But the variable component will keep changing because I want to multiply the $5 times the 100, and that's going to give me a different number when I multiply the $5 times the 200 every single time. But take a look at this. When we're dealing with fixed cost per unit changes with the level of activity, but there is an inverse relationship. So the more activity I have, the lower my fixed cost per unit. But here's the interesting thing. When I multiply my fixed cost per unit times the number of units or customer repairs, I'm going to get the same dollar amount every single time because a fixed cost in total remains the same regardless of the level of activity. But that fixed cost per unit, you're going to see that inverse relationship. So when we plot our line here, I can look at this without reading this and automatically know that this is a mixed cost. If it was a variable cost, I would have started at 0, 0. If it was a fixed cost, there would be no tilt, there would be no slope. It would just be a flat line. But because it starts at the 3,000 level and it continues to go up, that is my mixed cost. So when I have zero activity, I still got to cover that 3,000 in fixed costs. And of course, as the number of repairs increase, total costs increase. That is the perfect definition of defining cost by behavior. All right, here's the graph for unit variable costs, because variable cost per unit remains the same regardless of the level of activity. But in total, it does change. And then for average cost, the more units I repair, or the more units I have, the lower my average cost per unit. I have more units to spread the cost across. So of course, the cost per unit is going to go down. Now, with fixed costs, we could have different types of fixed costs. There are some committed fixed costs, which means regardless of what's happening, I'm going to have it there, whether I'm operating at full capacity or below capacity, 80% of capacity, and then I have to maintain those costs to maintain my current level of service. For discretionary fixed costs, I can eliminate them and it's determined by management. So a good example of that one would be advertising. With my advertising cost, management can decide to have more advertisement or less advertisement, but the advertisement isn't necessarily driven based on how many units I expect to sell. It's based on what we're willing to pay for advertising. So that's discretionary. For some committed fixed costs, things like depreciation, the production supervisor's salary, those things would be committed or capacity fixed costs. All right, that takes care of the first half of chapter 2. If you get some time, go take a look at the problem video. I have a couple of problems where I work through some examples from this half where we get to see a little more with numbers, a little more with average costs. I so appreciate your time and attention. I hope you learned something and I hope you have a wonderful day.